Hi, everyone. Welcome to a special edition of Market Musings. I'm Stephanie Link, and joining me today is Lee Maker-Zach in fixed income, Robert Picard in the private markets arena, and Mike Shea, also in the equity side of things. We're going to go over our 2025 outlooks, our thoughts, some themes, ideas. Hopefully, this will be helpful. I'm going to start it off, and then I'm going to hand it over to Lee, and then we'll go to Robert, and then we'll end it up with Mike Shea. So I'm going to start off and just by saying 2024 in the equity markets was an outstanding year. We had the 24th best year in the S&P 500 in performance. We had the 15th best year ever in the NASDAQ. And the last 4 out of the last 6 years, we have been up 20% plus in the S&P 500. Just to keep it into context for you, the long-term total return for equities in the S&P 500 is 7.7%. So we've had an outstanding few years. We all should feel pretty good, hopefully. A lot of it is because we've seen better than expected GDP growth. So 2 years ago, we grew at about 3.4% in the economy. And last year, we haven't gotten the finalized numbers yet, but about 3% is what we're expecting. And that was driven mainly because of a lot of the fiscal policies that were put in place. And in fact, over the last 6 years, we have put in a fiscal and monetary policies in place that is equivalent to 60% of US GDP. So if you go back, and we had to, right? Because we had COVID, we closed the country down, we closed the world down. I'd argue we kind of overdid it, and that's what led to a lot more inflation, but we had to do it during COVID. And we did it in spades. Putting it into perspective, in 2008, the last great financial crisis that we had, and it was a crisis because we had some big banks that failed. If you added up the fiscal and monetary policies together, that was about 5% of US GDP. So we put an enormous amount of money, an enormous amount of liquidity into the economy, and it also takes a long time to get into the economy, and it has led to better than expected growth. So fast forward to today, 2025, I think you're going to see more moderate growth this year, something like 2.5%, which, by the way, is still above trend. Trend is about 1.5%, 1.5%. So 2.5% is still a very, very healthy. And the reason I think we're going to see a little bit of a slower economy is because we have much less fiscal policies that are being put in place this year. That is going to be partially offset by the pro-Trump growth policies, right? Pro-growth, meaning lower taxes and deregulation and that sort of thing. That should lead to mid-single-digit earnings with maybe a little bit of margin expansion. Probably we could see upper single-digit earnings. And so I think earnings are going to continue to be revised higher. And we all know from on the equity side that stocks follow profits on the way up and on the way down. But that's not to say that we won't see more volatility this year than we have over the last 2. I think on the Fed, I think we're going to see less than two cuts. I think right now we're pricing in like 1 cut. Well, I'll leave it to Lee to go through the Fed and what the bond market is pricing in, but less cuts than expected. And a lot of that is because the Fed has a dual mandate: jobs, making sure that the labor market is healthy, as well as inflation is under control. Their target for inflation is 2%. We're running inflation about 3%. It's been very sticky, and I would argue it's sticky because of the better than expected growth that we have seen in the economy. And so if that's the case, the Fed doesn't have to cut as aggressively as expected, and they probably won't. And that might lead to the volatility that I'm speaking about. In terms of the job market, the labor market is very strong, and the wage numbers have also been very healthy. So that's very good for the consumer. And actually, there's 1.3 jobs openings and available at the current time for every 1 unemployed person. So it's still a very healthy job market, and that sets up well for the consumer for 2025 and beyond, as we know that the consumer is 75% of US GDP. I am watching the bond market. Again, I'm going to hand that over to Lee in a couple of minutes. But the 10-year is up a point since September. It's the highest level since April. And the 30-year touched 5% today. And I thought that was interesting. I think it's likely to continue to creep higher. But I would argue a lot of the reason is because growth is better and inflation is a little bit stickier, as I mentioned. So from an investment point of view, from an earnings point of view, I think that's okay. But I know that the market's not going to like that. That's why the markets are actually down today on a much stronger labor report. So 2025, I have a kind of a two-prong approach. I'm adding to winners, some of the winners anyway, but that corrected in December. So financials were down 6% in December. Still ended up 28% higher last year, but down 6%. Discretionary was up 26% last year, but fell 8% in December. And I think those are two areas that are very attractive to me. Financials, it's fees, it's activity, it's capital markets, it's net interest income, and it's deregulation. Discretionary, I just mentioned the consumer. Services is on fire. Housing is definitely controversial, but I like the housing market for the long term. And I like the gaming industry, particularly the Macau gaming stocks as well. So in discretionary, there's a lot of moving parts, but I see opportunities there. I want to also, as part of my two-prong approach, also add to the laggards, and I have been. Energy was up only 2% last year, and healthcare was up only 1% last year. And I think you could see mean reversion to parts of energy and parts of healthcare. My longer term themes, and I'll go quickly through them. As I mentioned, consumer, services, housing. I just want to expand on housing. There's a supply demand imbalance happening, and I think it's going to be that way for 10 years. So this is a long-term idea. I understand with a 30-year fixed at 7%, it's going to be a challenge maybe this year. It's going to be bumpy, but we have 5 million homes that we are short in this country. And we have 5 million millennials that are first-time buyers. And we have home builders that have underproduced for now 15 consecutive years. And so I think that that will continue. That market will continue to be tight. And so I want to have exposure. I don't have to probably, my next theme is I probably don't have to tell you much about AI. You probably all know about it, but I do think going from 250 billion market to 1.8 trillion between now and 2030 sets up pretty well for a lot of the companies that have exposure in this on this theme. Now you can own the tech names, which a lot of people do, myself included, or you can also add the non-tech names that will benefit from AI, the Internet of Things, manufacturing, automation, electrification. Those are very big drivers. AI is very big drivers for all of those industries. The other part of technology is cybersecurity. I think it's bigger than AI, and I think you're going to see massive M&A in this sector. We have 6,000 cybersecurity companies in the world. 6,000. Pretty much none of them talk to each other. That's why we have problems. I think you're going to see the big five get bigger. And I have exposure, pretty big exposure there. That's also a very long-term theme. I mentioned a little bit of Internet of Things and electrification, but I still believe very strongly long-term in the power, in grid. We're going to spend $4 trillion on the energy transformation in this country between now and 2050. And I want to have exposure there. Animal health, this is where I put my Peter Lynch hat on because I have 3 animals myself. But I do believe that the $150 billion that we're going to spend in this country this year and for the next 7 years, each year is going to be a nice tailwind. And there are only 3 names really to play. Innovation is the next theme, and that's new products, improving products. And then my last theme is it's kind of a catch-all. It's watching for shareholder returns. Companies that use their free cash flow, that's the most important thing that I look at in analyzing a company. And what do they do with that free cash flow? Are they buying back stock? Are they increasing their dividends? Those companies that have increased their dividends consistently at 10% or plus, I look for as certainly at reasonable valuations. Some honorable mentions. I mentioned that I am adding to financials. That is certainly a theme for me between now and the next several years. I think net interest income is underappreciated, and Basel III endgame capital rules will be less onerous on these companies, and you're going to see lots of buybacks. So those are a couple of themes, couple of ideas my way. I'm going to send it over to our fixed income expert, Lee Makerzak. It's all yours.
Thanks, Stephanie. Yeah, as you alluded to, we closed out 2024 with a bang in volatility, and that has really continued into the new year. Stepping back, I think there are a couple important themes that observations that shape how we view the coming 12 months from both a positioning and strategy perspective. The obvious one is that Treasury yields outside of 0 to 2 years are simply higher now than where we were when we started 2024, and I think that's notable because what we saw was the market adjusting its expectations again and again and again and again, right? We sort of joked about this a lot last year, especially when there was talk of 8 rate cuts in a booming economy that hadn't yet slayed inflation. We argued that that simply wasn't going to happen, and that there needed to be some reconciliation between rates and expectations. And it's particularly notable that the Fed held rates steady throughout most of the year, and then cut 100 basis points between September and year end. But over that period of cuts, the 10-year actually rose over 90 basis points. Another thing we saw play out was obviously the inverted yield curve, right? Twos, tens ended 26 months of inversion, going from negative 35 basis points to plus 35 to end the year. The debates for me were particularly entertaining to watch. I think it was much more focused on the historical correlations rather than the details of what was actually happening this time around and why that was happening. And then lastly, credit spreads was a big story in 2024, right? They performed very well. Spreads have tightened to near or all-time highs, which really reflects, a confidence in corporate America, a confidence in the municipalities' balance sheets, and a positive overall outlook for issuers' ability to service debt. So, you know, those themes aside, where does that leave us going into 2024? And I think it starts with the baseline that we are in a really, really good place for income, right? With the recent rise in yields, the value that is offered to investors here across the spectrum is a historically attractive level to start the year. And I like to think about an outlook from the two main levers that we have in fixed income portfolio management to sort of start from, and those are credit and duration. Credit, how risky do you want to get? Duration, how long do you want to tie up your money for, and where on the curve do you want to be? Now, the easier of those two to talk about right now is credit, and it's really just as simple as recognizing that spreads are at all-time lows. So this is where, bonds differ from stocks if we're going to 101, right? New highs in the S&P can continually be broken because companies can keep on growing, but spreads are somewhat limited by the fact that no municipality or corporation is ever going to trade through the full faith and credit of the US government. Said another way, there's a limit to how tight spreads can get, and we're basically at that limit. Our team, everyone on the team, we share an optimism for the US economy. And yeah, you could see some more tightening above trend growth. We could, I suppose, set new records for how low spreads can go. But I think it's fair to say that the bulk of return this year is likely not going to come from some US macro spread tightening story. So what that means from an actionable perspective is that high grade credit is somewhat on sale, right? The differential you pay from going from, say, a double B credit to a triple B credit is less than you would pay in many other environments. And because we're in this high rate environment, even after that trade-off, that yield give up that you paid to upgrade your credit quality, you're generally still north of a 5%, which is a meaningful yield, which helps, financial planning and can make a difference on client, financial plans. Um, the most important piece of the outlook, though, is what yields will do, right? The million-dollar question. We think that spreads remain subdued. We think, though, that the yield curve normalization could continue, right? So that's the yield curve steepening. Some of that will happen through Fed cuts, though how much of that is going to happen is up for debate, right? Last summer we were at 8 cuts. We ended up the year with 4. As you talked about earlier, Stephanie, the pricing for 2025 is just above 1 cut, right? So we've come a long way in. And with the SEP projections, right, where the Fed thinks that Fed funds is going to end the year, we jump from a 2.9% to a 3.4%. And I really think that provides a floor for a 10-year treasury, well north of a 4%, right? If you look at a normal yield curve, you have an upward sloping curve, and a 3.4%, it provides a significant amount of basis points for that 10-year to sort of stay where it's at. And as I'm speaking, this is basically happening, right? We have a 475 10-year today on the backs of the economic data that was released. I think we can all agree that the final leg of inflation is clearly sticky, and that sort of adds to the floor. You combine that with the fact that the White House and Congress are aligned. Some of these big agenda items, if they come to fruition, the market has mostly discounted the inflationary aspect of them, like tariffs and immigration. But nonetheless, those are risks that I wouldn't completely ignore, because they could have significant upward pressure on yields. The good thing, though, is that as investors in this market, we don't have to ignore those risks, right? This cutting cycle could very well end up being much shallower than anything we've ever seen on a historical basis. And that means that the front end rates will likely remain elevated. And so the focus is on getting exposure to these meaningful levels in the intermediate and long end, and then taking what the market is giving us elsewhere. And what the market is giving us is cheaper upgrades to your overall portfolio quality, and optionality in the form of high end front rates, right? I think, we can all agree that volatility seems like a constant these days. So splitting your portfolio between getting paid to keep your options open while also not missing some of the yields that are just right in front of you, should the environment drastically change, it really seems like a prudent strategy for 2025. And we express that currently in the form of a barbell, right? So this dry powder on the front end, getting paid to wait, while also not missing, like I said, the opportunities, the 5%, the 6% yields that are right in front of our face is how we're looking at the year coming ahead.
Thanks, Lee. Robert, for a look at the private market side of things.
And good morning, Stephanie. Thank you very much, Lee. Thank you for the update. And just before we forget, I know on behalf of Stephanie, Lee, and Mike, just a quick shout out to all of you, both clients and or practices that have been impacted by the recent fires in California. Just I'm sure that it's an evolving tragedy, one that'll definitely have some impacts over the coming year. And I know Stephanie's going to address over the coming months. But our thoughts go out to all of you. And just a few thoughts. On that note, private markets, thank you, Stephanie. So just the way we frame private markets here at Hightower under Stephanie's leadership is we purely look at it as a complement to what you currently own on the equity and on your fixed income side. And we believe that it's additive to your portfolio. And I always refer to it as the power of private markets. And just let me recap briefly just some context and opportunity that we see within private markets. Just, we see it as kind of less efficient. There's a lot more return dispersion in private markets. And for that, you always should have a seasoned team of professionals analyzing and reviewing those opportunities and how they complement your portfolio. And just to frame this, and the opportunity that exists today, right now, currently, across all the companies in the United States today that generate more than $100 million in revenue, 87% of those companies are still private. They're typically operated by a founder, and there's just significant opportunity in the event and provided that you find the right team. Obviously, Hightower and under Stephanie's leadership, we're well positioned to analyze and evaluate those companies. And really, clearly there's a benefit there because the average university endowment, the average billionaire today have more than 50% allocated to private markets. And I always refer to 50 and 5. And if they have more than 50% allocated to private markets, the average individual investor has less than 5%. And there's just a significant opportunity to complement your portfolio and improve. So it's something to take a look at. Again, we're not suggesting to dive in aggressively. Our point really is that this is purely a complement. And some of those opportunities that we see for the coming year are not dissimilar from what Stephanie just alluded to. Specifically, for instance, in private equity, some of the areas we're looking at, the idea is to plant seeds. Some of those opportunities that are not necessarily as obvious in public markets are significant opportunities in the private markets, such as cybersecurity. That would be one area. Artificial intelligence. We've seen an increasing acceleration. We refer to as digitization 1.0, which was the internet and mobile evolution. Today we have digitization 2.0, which where historically 1.0 was a 25-year cycle. We see this as a 10-year cycle. And that really relates to artificial intelligence. And that is going to impact everyone, all of us. We use it already on a day-to-day basis here at Hightower. And most importantly, all the impact that's going to have, because that's going to evolve across different sectors within private markets, whether it be technology. It also is in real estate relating to data centers, the need for additional bandwidth and or memory and or storage. So data centers are evolving, and that becomes a opportunity for us. And then also technology has greatly impacted and will continue to impact healthcare. And that sector, with the aging demographic, the aging of the population, we see over the next 10 to 20 years significant changes coming where technology will not only improve and make healthcare more efficient, but most importantly, where many of us have experienced over our careers, sort of a boom bust cycle in biotechnology. With technology and with artificial intelligence and other elements, the speed at which products are being developed and coming to market, the trial period has greatly evolved and sped up. And I really do believe with gene editing technology and a number of other solutions, we're going to see, similar to AI, significant opportunity in life sciences and healthcare sectors. Another 2 or 3 areas we're looking at are royalties. Many of you are probably familiar with music publishing royalties. There's a whole new market, which we estimate to become between $5 to $10 trillion over the coming years in royalties related to minerals, energy, healthcare, publishing, books, and movie and film. Large studios are selling their royalties off, and that actually becomes a great way to generate fixed income. So on one hand, I talked earlier about how we see private markets complementing your public equity. It also complements in a non-correlated way your public fixed income, Lee's world, where royalties, for instance, can generate income for you owning an asset. And then lastly, private credit, huge opportunity that we continue to see evolve. And a lot of that relates to just the fact that banks are moving away from certain lending areas. And we're seeing a lot of community banks. There's probably too many in the country, currently north of 4,000. We see that community banks being reduced over time. And a lot of that activity is going to be picked up by private credit, where you'll have the opportunity to participate and invest in funds where you're basically lending out money with some of the leading lenders in the world or professional market makers in that space. And then lastly, real estate, we alluded to it, Stephanie alluded to it on the housing side. Build to rent communities, single family rentals. There's a dire shortage in the country. And there too, we see significant opportunities. And I'll leave it at that. Just to summarize, great opportunities that complement your traditional public equity and public fixed income portfolio in private markets. Thank you, Stephanie.
And that's what's so fun, Robert, right? That we on the public side have ideas, and when you have the same similar ideas on the private side, we have to be doing something right, right?
No, we are. And most importantly, just to add, these are relatively less liquid investments on the private market side. So we don't necessarily recommend a large allocation, but what we do insist upon is that you get to participate, but you be rewarded for that illiquidity with additional or higher returns where possible. But again, we complement everything you do, Stephanie, and Lee does on the fixed income side.
And you brought us some wonderful deals. So thank you for that, Robert.
Thank you.
And last but certainly not least, Mike, you ready to go?
I'm ready. Thank you,
Okay.
Stephanie. Good morning, everybody. This will come as no surprise to any of my friends here, but this is the time when the webinar becomes all about me. I had a birthday a couple of weeks ago. Without being too terribly specific, I'm uncomfortably pushing 70. And it got me to think a little bit about my cohort, some of whom are probably here today, people who were born smack in the middle of the baby boom. Now, well past retirement age, at least by normal standards. And it's probably a commonplace idea that my demographic has a little bit of an issue with, well, how do we invest today? What's right for me? Because is this really all about AI? Is it really just NVIDIA? Is that what we're reduced to? We just have 2 things to think about? Or do we have other things that are appropriate, even attractive, that are not on anyone's radar screen? And I would just suggest a couple of things in the time that we have left here. There is value everywhere. I've been a value investor for better than 40 years, and the opportunity set in value is all over the place. Well, we never know, and in this style is, well, when will the market care? It can be gradual, or it can be like this morning. It can be all of a sudden things that you contemplated investing in for months, maybe longer, struggled with, suffered with, maybe this is not a good idea that I'm invested in energy or whatever your idea of the day is. Those things don't feel good for long periods of time, and then all of a sudden they show up at the party. That's very, very common. And it takes some emotional fortitude to be able to put up with the slow periods, but the rewards are generally well worth showing up for. Some of the things I think are attractive today, and Steph talked about a couple of these. Energy is an unbelievably good opportunity, and nobody is there. And you can see it in the price action all of a sudden in the last week or so since the new year turned. Energy stocks have been out of favor for quite some time, other than a nice flourish in 2022. Since then, it's been quite a lot more difficult to generate returns. But we're now at a period where a couple of things are coming together that I think are worth talking about. Supply is not quite as good as everyone thinks, and it's going to show itself in a couple of ways. Petroleum products from Ukraine and from Russia are being constrained. The Europeans can't get out of their own way. They're continuing to impose restrictions and windfall taxes and things on exploration in the North Sea. If you restrict it, you won't find it. And I think that'll come to bear sometime in 2025. And there are certain early signs now surfacing that returns from the Permian are not quite as good as advertised either, and those are short-lived assets. That all puts together a picture for us where valuations are crazy cheap. You can put together a package of the companies in the industry. I would highly recommend that you all look deeper into that. There's a second group that's really interesting to me, and it's in the headlines this morning. That's the insurance business. Those are very, very cheap stocks. Pricing in insurance, especially in property casualty, as you all know, has been through the moon for the last 2 years. All you have to do is open the mail. Your bill from State Farm is up 40% in the last year. The same goes for Geico. The same goes for anyone in property and casualty insurance. There's a lot of pricing power there. And while you hate that as a person, as a consumer, we love that as investors. Pricing power is the holy grail. It goes straight to margins. It goes straight to the income statement. We like that a lot. Ironically, because of the fires in California, the stocks are down a whole lot today. And it's giving us an opportunity to get involved if you haven't been in these things already. But the way this will work from here, very likely, is that property and casualty insurers who have gotten completely hammered in the storms in the Southeast and now the fires on the West Coast must have rate relief. There has to be a combination of an effort from the government and from state regulators to keep these companies on their feet, or the industry will no longer exist, and that's untenable. It's not something we want to have as a country, that insurance becomes a federal government operation. So there must be relief that comes to the benefit of these companies. I expect to see that happen over the next couple of months when the fires are out and we start to approach something that looks like normalcy. And I expect that these will become very good performers in the stock market again. The last thing I'll touch on is the value person's way to invest in AI, because there are other things that are interesting besides the tech itself. And a very simple way to go here is to look at utilities. We've heard from the electric utility companies for the last 3 quarters that their demand for new power is off the charts, on the order of 8 to 9% increases, and that's been for 3 quarters in a row. I don't see that dissipating at all. The underlying demand for power from all sources is through the moon. These are very cheap stocks. Excellent income generators for my cohort, people in the middle of the baby boom. And Steph, I'll stop there.
Well, thank you, Mike. Thank you, Lee. Thank you, Robert. And thank all of you for tuning in to us. Hopefully we're all going to be right. But but we're certainly all going to be very humbled as well. It is certainly a challenging time, but there's a lot to look forward to. And the beginning of the year is always a really great time to share ideas and thoughts. And so if any of you have any questions or if you have any comments, we would love to hear them. And we'd be more than happy to get back to you. And so I hope everybody has a wonderful 2025. We will see you in June in the midpoint of the year to go through all the things that we've been talking about and then some more ideas. And thank you all.